Would you like to start investing in the stock market but don't quite know where to begin? Believe it or not, making money off of stocks isn't necessarily the way you might see it portrayed on social media or in the movie. In fact, millions of Americans earn money passively every year off of the markets with little to no trading at all. In this video, we'll explore how you can safely get involved with investing in stocks. We'll also explain where to get started and why it's a golden opportunity that you won't want to pass up. Welcome back to the Investing Circle, where we have videos and posts on all things passive income, financial freedom, and making your money work for you. So let's kick things off. Why do people invest in the stock market anyways? When done strategically, investing in the stock market can be one of the most effective ways to build sustainable, long-term wealth. People from all walks of life have become millionaires over time by taking advantage of one of investing's greatest features: the compound interest effect. The compound interest effect is when money builds on top of both your contributions as well as any previous earnings. To illustrate this point, consider what would have happened if you had invested $1,000 in the stock market back in 1982. 40 years later, it would be worth $86,352. I'll go ahead and post that link in our description below so you can actually see where that data came from. How is that actually possible? It's because generally speaking, the stock market tends to be trending upward, increasing in value with time. Additionally, investors periodically may also receive distributions called capital gains and dividends that they can use to reinvest into the markets. All in all, this causes the initial investment to multiply over and over again. And when done systematically, it can lead to a sizable portfolio that will allow you, the account owner, to retire someday. So what should you actually invest in? Well, there are dozens of financial products that can be used to make money off of the stock market. Here are a few of the most popular options for beginners to consider. The easy one, individual stocks. When someone says they own a share of stock, what they mean is that they have a piece of ownership in a publicly traded company. These can be well-known names that you're already familiar with, like Apple, Walmart, and Amazon, or they might be from any of the other thousands of registered businesses. As companies perform well, their stock becomes more desirable and the share prices will increase. However, the inverse is also true if the company misses earnings targets or experiences negative publicity. Buying stocks individually gives the investor full control to pick and choose the ones they believe will do the best over time. However, it can also expose them to risk if they're not well diversified in their selections. Next up is mutual funds. What if instead of buying one or even 10 different stocks, you could buy hundreds or thousands of them with a single purchase? Well, that's exactly what a mutual fund does. It's a collection of assets that you and other investors purchase with a shared pool of money. Besides being incredibly simple, mutual funds are diversified by design, which significantly lowers an investor's risk of loss. Mutual funds can also contain other assets beyond stocks, such as bonds, real estate, and crypto-related products. Next up is ETFs, or exchange traded funds. An ETF essentially takes the concept of a mutual fund and packages it into a financial product that can be bought and sold on the open market, just like a stock. Investors get the same benefits of simplicity and diversification, but ETFs also offer the extra advantage of having lower fees than most mutual funds. Finally, we have index funds. What if, instead of trying to pick your own stocks and beat the stock market, you simply just bought the average return of the stock market as a whole? That's the concept behind an index fund. Indexes are collections of assets that are used as broad measurements of the market as a whole. You hear about them every night on the news or whatever you actually watch to figure out what the news is. One of the most well-known ones is the S&P 500, the 500 largest companies in the US. A good example of that would be Vanguard's VOO. Many financial experts have praised index funds over the years, claiming that even professional fund managers can't beat the overall market over the long haul. Roughly an average of around 10% per year. I'll also post that in the comment section or description below. Effectively, that means someone with absolutely no investment knowledge could put their money into an index fund and most likely be more successful than the majority of people who tried their hand at picking individual stocks. So how do you actually get started? To start investing, you'll need to first set up an account with a financial platform to serve as your brokerage. Here are a few of the most common ways to do this. The very first one is a trading app. Right? So a trading app makes buying and selling stocks, ETFs, and even crypto as easy as a click of a button from your smartphone. Simply download the app to your phone, connect your bank info, and then you're ready to go. Popular options include both Robinhood and M1 Finance. I personally use Robinhood for my options trading. The next up is robo-advisors. If you're not confident in your ability to build a diversified portfolio, then why not let a computer do it for you? The market is full of a new breed of brokers called robo-advisors, where an app picks out your investments based on your answers to a few simple questions. Consider platforms like Wealthfront and Betterment. Next up is traditional brokerages. If you like to partner with a financial platform that you can grow with, then going with a full service brokerage might be the way to go. These are established, well-known financial companies that go beyond buying stocks and can also offer other services such as financial planning. Check out classics like Vanguard and Fidelity. A note here is I do use Vanguard for both my Roth and traditional IRAs, as well as my self-managed brokerage, and that's actually where I do a lot of my option trading as well. Finally, there is the retirement plan section of this entire video. Does your employer actually offer the opportunity to participate in a 401k retirement plan? If so, then this is essentially an investment account that gets special tax advantages and probably won't be in any of the things that I've mentioned so far. Even if the company you work for doesn't offer a retirement plan, you normally have the option to open another type of account called an IRA or a Roth IRA with a financial institution of your choice, which I did mention with Vanguard. By far, retirement plans are one of the easiest ways for an average person to get involved with investing because they won't have to manage the taxable gains every single year. Plus, since most participants make automatic contributions with each paycheck, you'll be regularly investing without even realizing it. The moral of this story is whatever you do, don't actually wait to do something. No matter what you decide to invest in and how you go about it, the main thing to keep in mind is just don't delay this. The compound interest effect takes time to make your money grow, and that will only happen if you take the initiative to actually start investing right now, today. That's why the most important thing for you to do is to take the first step and start putting your dollars to work. Thank you for watching the video today on how to get started in investing in the stock market. Please like and subscribe to our channel if you enjoy this type of content, and please leave any questions, comments, things that you want to hear about on passive income, financial freedom, and making your money work for you in the comment section below. See ya.